Yeah, thank you very much. That works, right? Thank you very much, and I'm really glad to be here. And before I start, I should, however, say that I'm not 100% comfortable with the title of my presentation because it suggests a very technical presentation with a lot of technical detail. And I must say, I'm not a technical person. My background is insurance, always has been. And again, I'm certainly not yet a digital. And that makes me feel a little bit humbled on the panel. I'm the only one non-digital on the panel. And until half an hour ago, I would have said I'm probably the analog complement to a digital panel. But after Steve's presentation, I know a new technical term, so I'm clearly the dinosaur on this panel. So a warm welcome from the dinosaur. And I'm very passionate about our industry, and I'm very excited about the future. So that's the reason why I was very delighted when Tim invited me to speak here, and I happily accepted. What I suggest I do, though, I don't focus too much on the technical details. I try to put the things we are doing at MunichRe into a wider context, both in terms of scope and of time. So let me try to talk about MunichRe's approach to the future. What I try to do there, I try to basically answer 4 questions. Why are we doing what we are doing? Where are we doing it? How are we doing it? And so what? So, why? I guess like everything in life and in business, it depends, or it's a matter of opportunities and threats. It's a balance between the two. In our industry, we'd probably say risk and reward. So where do we stand now? And to define that, maybe look back, where do we come from? What have been the major themes of our industry in the last, let's say, 10, 15 years? In the early 2000s, clearly we were coming out of a period where we had to repair our companies, repair the balance sheet, repair the processes, introduce enterprise risk management, and respond to even tighter regulations. Then we had the global financial crisis. After that, a series of major NatCat events here in this part of the world where we had to deliver on the promise to society. At the same time, you saw a massive consolidation of insurance companies, mergers and acquisitions, and then an environment of low interest rates, which not only deteriorates our investment income and puts pressure on the rest of the business, but also introduces new competition to our business. So all in all, one would think more threats than opportunities. However, where we are now, innovation comes into the game. So let me try to run through how we see the environment. It's basically 3 major themes that we are seeing. It's technology, data, and consumer behavior. So let's elaborate on that a little bit. Technology, digitalization and new technologies. That means 2 things. It means, first of all, our risks are changing. What we are insuring, the subject matter of our business, can change fundamentally. It could reduce the risk that we are seeing, and new technology like automation, sensor technology, etc., could play a big role in reducing it. Think air traffic, for example. For the last 30 years, it has become safer and safer and safer. Reason is automation and technology. The same thing is bound to happen with car traffic, road traffic, so also that will become safer and safer. With the result, there will be less accident, there will be less for us to cover. The volume of this piece of business will certainly go down. So that's bad news. But there's also good news. New technology means new risks that needs cover, that needs protection, and therefore is a business opportunity for us. Cyber is probably the most cited one. I think it's a good example, but there are others as well. In terms of technology can also mean that there will be changes to our value chain. Because technology means not only our business model is changing suddenly, but also of other companies. Maybe a question for you in the insurance industry, whom are you afraid of as competitors? Is it your current competitor? Is it 2 men in a garage? Or is it, if you're a motor insurer, is it the likes of Toyota? If you talk to BMW, for example, the way how they define their future is not to be a car manufacturer. They define their future as being a mobility provider. And mobility provider, security around mobility or insurance around mobility could be as much part of their business model than it is providing a car for mobility. So I guess the lines will blur there and we will see new competition. Let's move to the next one, data. Clearly the amount of data will increase exponentially as we have just heard. our industry has always been an industry around data and innovation. Clearly, that's a thing where we need to be on top of the game and where we need to invest. The current stage, however, is that a lot of us as companies, we are investing in legacy systems or have to deal with legacy systems which are a factor of our history, corporate history of mergers and acquisitions. So we are restricted in our ability to invest there. But we have to, because it's a race for data, and I think that's a phrase often cited, data is the new oil, particularly for our industry. Largely, changing customer expectations and behaviors. Customers want to interact with us faster, easier, and more digital. If you look at the other industries that were disrupted, and Steve mentioned music, no? The way recorded music. You can also think of digital photography. Why was it disrupted? Not so much because the new product was any better or it was cheaper. It was all around consumer convenience. So can I ask you, how convenient is it to buy insurance? How much fun, how good is the shopping experience buying insurance? I've yet to find somebody who buys a second homeowner's policy just because of the fun of buying it. So I guess this is a thing where we really need to watch out. So this is, I think, very much the reason, and I think pretty clear why we need to invest, why we need to move forward, why we need to change. The question is now, where do we do it? And there we have 4 major buckets as MunichRe, where we are preparing for the future and we are accordingly heavily investing in. It's new clients and demands, it's new risk-related services, new reinsurance products, and new or enhanced business model. I'd say a lot of what we describe as disruption would find itself in the 4th bucket, but let me start with the 1st bucket first. And excuse me for leaving the tech theme there for a moment, because it's somewhat different. It's funny as a reinsurer if you talk about innovation and as a company who has essentially been selling the same product for 120 years. So our reinsurance products are really unchanged. They have been around for a long, long time, and there were certain tweaks and certain additions, but at the core it's a very, very same product that we sold. What has changed, however, is why we are selling it and why you are, or more particular, why you are buying it. If you try to ask yourself, why am I buying reinsurance? It's probably a good thing if you ask yourself the question, what do I see in my reinsurer? How do I regard him? And there are 3 options, I guess. Do I see him as a supplier? Is the reinsurer a supplier who delivers you a resource that you need to run your business? And accordingly, you try to get the best deal for it, the best price, you renegotiate, and it's a fairly replaceable thing. So a fairly opportunistic relationship, which is nothing wrong, you could do. But in this part of the world, there is massive need for reinsurance because of the extreme events that we see here, extreme exposures that we have in this region. So you are probably buying a lot reinsurance. If you then look at it, sit back and say, look at it and realize that what you're doing is essentially you're recapitalizing your company on a yearly basis for a large part of that. And that's on an annual basis. All other capital sources have a much greater longevity. You wouldn't do that on an annual basis. If you have that thought, then you probably see your reinsurer much more like an investor. And with that, you probably have different conversations with him and expect a different skill set on the other side. That's clearly a new demand that we are seeing, and we are investing in it. That's part of being fit for the future for us. But again, it's not around technology, it's around competency and experience and expertise. A third way of looking at your reinsurer could be that of a partner. You see a partner that can provide you with services, with expertise that helps you to develop your own business. If that is the case, probably a lot of the services and expertise that you're expecting from a reinsurer would be of a technical, or would be of a data background, would be of an analytical background. So voila, we are now back to the technology part. And then in the next 2 quadrants, I probably give you some example what that means. So we are investing in new risk-related services and new reinsurance products. So risk-related services, again, 2 concrete examples that I would like to give you, one with an IoT background and one with a geospatial background. IoT, the first one, MunichRe. MunichRe is a technology company based in the US who we've partnered with. Actually, I think we even bought part of that in order to do one thing, to provide sensors that we provide our clients with. It's around machinery, and what it will do, it will collect data and make it available to the users, to the policyholders on an app, basically, on a mobile device, that they can track the machinery at any given location in a very user-friendly way. With that, we are adding to the insurance cover also loss mitigation, loss prevention services to that. So clearly, MunichRe will be in the business of providing sensors going forward. Second example, Mind. Mind is a geospatial platform around natural catastrophes. MunichRe has always collected, or has been collecting data for a very long time around natural catastrophes. It used to, and we shared that with our clients and with the society, and it used to come in the form of the world map of natural hazards. Well, in the 90s, we added a third dimension to it, and the map became a globe. And then later, it was transformed into a digital database, which is available online, called Nathan. So that's about exposure data, which we share. Mind is different, though. It's the next step. So you can blend the exposure data with your own policy data, with third-party event data, and then also overlay it with satellite images, aerial photographies, and with image recognition. It can help you not only to manage your portfolio, but also manage your losses, direct your loss adjustments, or even automate some of your loss assessments. The projects that we're currently running, one is in Mexico, and the other one is in the UK. So that as examples for services. As an example for new products, I'm sorry, it's again cyber. And I don't want to elaborate on that too much, but I think it's just such a good example as a stereotype for future products that will be out there, because it's an exposure that is changing gradually. It's not a constant thing, it's dynamic. It changes. With that, we need to stay on top of that and fully understand the exposure. It's a different way. It's more static. It's much more dynamic. B, it's not only about paying losses, it's also about loss prevention, because you, as a policyholder of a potential cyber policy, much rather than having the losses paid for, you would like to have either the loss being prevented or being mitigated. And that's exactly what that does. And obviously, we can't do it alone, so we partner with service providers and with tech companies to provide that service then to customers. The potential, I guess, is fairly big. So far, it's been very much in the US, but other parts of the world are expected to grow significantly in the future as well. So we develop that, but we tread carefully because we understand it is a changing exposure, and we increase our risk appetite as we learn and as we go along. Then last example, and then now we are into new or enhanced business models, and that's probably the part of MunichRe innovation where you hear the most about it. That's usually the examples that you see in the press. What it is, it's around digital partners, and digital partners is a business unit that looks to partner with startups, with startup companies that have a business model very much around the consumer experience, so very much addressing one of the core issues of our industries. Some of the names like Choff and Slice, you may have heard, that's basically insurance on demand, a model. Others like Bought by Many or Simple Insurance, it's targeted at a particular group of customers and with a very particular service offering. Blink, like others, focusing on the consumer experience pretty much in the claims area. So what we do is we partner with these companies, and everything that we bring to the table is the stuff that usually the policyholders don't really see. It's the underwriting, it's the capital, and it's the license. And of all the investments that we're doing in innovation, this is not the focus, but it's probably the most prominent piece of what people hear the most. But it's not our focus, it's a little bit a bet against disruptors. Another way of looking at where we invest would be just to look at the classical value chain of insurance. And what you see here, and certainly these are fairly familiar buckets and groups, what you see in the bubbles there is the VC investment that went into the particular field since 2008. No? Not by us, but generally, overall. And what you see is a clear focus on sales and distribution. So that's a little bit addressing the point of the consumer experience, predominantly on this, or first and foremost on the sales side. And that's, I guess, where most of the money was invested in. However, what we tend to forget is that the consumer experience basically has two main touch points. It's the sales and it's the claims. And a lot of, if we keep customers or not, if they're happy customers or not, will be decided in claims. So, and there, amongst all the categories there, it's a lot about fraud management. We spend an awful lot of time and energy in trying to prevent fraud. And that's usually the part which upsets the customers, not only the fraudsters, but also the other ones, the honest ones. And the question is that something that you have to address only in claims, or will modern analytics allow you to actually address it in some of the other parts? Can you detect early if somebody has a fraudulent behavior? Can you detect that already in the acquisition or underwriting phase? Certainly credit rating is said to be a strong indicator for that, but that's certainly one where probably overall the consumer experience can improve a lot. So that's, I guess, for the wider industry. For MunichRe, we realize sales and distribution, interaction with policyholders, that's not our DNA. We don't really have any expertise in that. Where we have a right to play is in the area of risk analytics, risk understanding, and claims management. So where we put our energy is rather in these buckets. So we don't really are heavily investing into the sales and distribution field. So that explains a little bit the where. Now let me move to the next part, to the next question, and that's the how. And I guess that's important to understand. There is a difference. There's a big cultural difference between insurance companies and technology and companies and startup companies. Some of it is very obvious, others is not. The obvious one is obviously size and company culture. We are a tightly regulated industry, regulated for the sole purpose of security. We have to provide security to the policyholder and the public. And as a company, you can optimize yourself or try to improve in various categories. Security being one, efficiency being another, and speed being probably the third. There's a trade-off between the two. You can't be good at everything. So obviously security is very important. And the industry is all over the world with slight deviations, but overall the major theme is that we're being regulated to withstand a 200-year event. No? So that it's oversimplifying, but that's sort of the risk calibration that we are subjected to. Which means if you flip it around, so the average life expectancy is said to be about 200 years. No? Well, startups different. No? They think in weeks and months and not in decades and centuries. With that, it's not only the capital base which is regulated, but all internal processes are geared to that, are geared to provide security and make sure that we will survive extreme events. On top of that, we are in a competitive environment, therefore we have to be conscious of costs. So we increase efficiency at the same time. What we're not so good at is speed, clearly. That's the trade-off. Startup is different. Startup, they don't think about too much of security. If they go bust, then they go bust. Okay, they run full risk, but for the sake of speed. That's the only asset which they have, and therefore they optimize speed. They don't care about efficiency too much. If two things are doing the same thing, fine, if that gives them additional speed. So that's a fairly diametrical match of corporate cultures. Another thing, risk profile. We think, well, startup is a risky business, so is ours. So we know how to manage risk, and that shouldn't be too foreign for us. We should be able to do that. What we tend to forget is that the risk profile is just diametrically opposed. In insurance, we need a lot of small gains to finance the one big loss. So we expect a lot of small gains, and we are okay with a very big loss. In startups, it's different. You expect a lot of small losses. You expect that the company will go out of business in order to have the one really big gain, to find the one unicorn. You expect to have a lot of small losses. So that's very different to us. And for us as an insurance company, we have difficulties to culturally accepting a small failure. That's what we don't do that. Even our language suggests that we said, well, you shouldn't think in problem, you should think in solutions, no? That means just look harder, there will be a solution, there will be an upside at the end of the day. So we don't admit that this is it. So, but if you're riding a dead horse, for God's sake, don't think in solutions. Accept it's a problem and get off that horse. And that's exactly what startups do. And a term which they dread, they said, we don't want the slow no. Insurance companies always give us a slow no. We want a fast no. A no is okay, but it has to be a fast no. So there's a big difference, cultural difference, and in order to successfully cooperate, that means we have to run our innovation initiatives outside our mainstream business. And that's what we're doing. I think we realize that innovation happens at different centers. It doesn't happen necessarily in the main insurance centers that we are used to. It happens differently. The way of working is different, and we're applying different techniques. So what we have, therefore, let's say our global, what we call innovation footprint, we have presences in the major innovation area of this world. The first one, obviously, was in Silicon Valley some years ago. A notable one, because I mentioned cyber, Tel Aviv. Tel Aviv is a center for cyber technology. Some of the best companies are found in Tel Aviv. So that's, if you're in that game, this is a good place to be. Plus, then we have a lot of labs in basically all continents that we could use to develop and co-create innovation with clients and companies from the startup scene. So that's pretty much it from the how. Now the so what. And let me share a cartoon with you. That's in a cartoon that was published in a German insurance magazine earlier this year. And it's a response to a lot of the publicity that MunichRe got around the innovation activities. And well, the first, honestly, I don't like it. I think it's wrong. I think it's really wrong, because it suggests that reinsurance and innovation are two different things, and it's not. Reinsurance and insurance we've always followed innovation. Actually, we have not innovated ourselves, we facilitated a lot of innovation and a lot of progress because we absorbed the risk that was associated with that. So I would definitely change that. What is true, MunichRe is changing. We are not changing our business model, but we are changing, and we always have. So to conclude it, what's our global approach to innovation? I guess it's pretty much what we have always done. Embrace innovation, use it, and develop progress. I don't think that is a great deal of different. What is different, however, the speed is different. And I'm not sure if I should show the last slide. Steve made me hesitate, but still I tend to say some might call it business as usual. Thank you very much.